First, the good news. The IMF is encouraged by strong consumer and business confidence, raising its global growth forecast this year to 3.5% and maintaining its 3.6% outlook for 2018.
Acceleration will be broad-based across advanced, emerging, and low-income economies, building on gains we have seen in both manufacturing and trade.
The IMF is projecting China to grow over the next 2 years 6.6% in 2017 and 6.2% the year after. But there is some concern about the longer-term implications of elevated debt levels there.
Its desirable rebalancing process continues, as seen in a declining current account surplus and an increased GDP share of services. Yet growth has remained reliant on domestic credit expansion so rapid that it may cause financial stability problems down the road.
The IMF is also maintaining an upbeat assessment for the United States, with growth projected at 2.3% this year and 2.5% the next, assuming the US Congress passes stimulative tax reform legislation. But the fund's economists are worried that a sharper increase in the value of the dollar could hurt emerging market countries at a time when some are still recovering from the commodity downturn. There's also a warning from the IMF about protectionist policies in the United States and Europe.
A broad withdrawal from multilateralism could lead to such self-inflicted wounds as widespread protectionism or a competitive race to the bottom in financial oversight, a struggle of each against all that would leave all countries worse off.
The fund is urging political leaders to invest in better education and workforce training in order to ensure that the clear benefits of global trade be more broadly distributed. With that issue in mind, the IMF also wants to draw attention to the issue of slow productivity growth, meaning the ability of individual workers, businesses, and industries to make the most of their resources. Daniel Wrenches, CGTN, Washington.